In this video, we're going to look at Weis Markets, and this company is a little gem in the market that not many people are familiar with, but they've been listed on the stock exchange since 1965, and the Weis family owns 65% of the company's stock, and they operate 198 grocery stores in Pennsylvania, Maryland, New York, New Jersey, West Virginia, Virginia, and Delaware. It seems to be a really undervalued stock, and the way I figure out the stock price is I run my discounted cash flow model to figure out what it's really worth to stock, and I use prior financial information. I also look at the capital structure of the business, and I look at the financial ratios. And I'm going to do this all in the video, so it's like we're doing it together. So I think this is a really exciting company to look at. Let's get started with the model. The market cap is $1.31 billion. So it's definitely not a small company. I prefer to only invest in companies over 1 billion market cap. I feel it's way too risky to invest in smaller companies. You could get a big return, but chances are you're going to lose all your money. And they're trading at 48.61. So now we need their free cash flows, and this is the cash flows that are left over after operating your business minus capital expenditures. And the way you value a company or any asset is you estimate the future free cash flows that that company or asset can generate. And then you discount that back to today, and that's how you get the value of the company. And that's what I'm doing in a video here. Let's get to net income. That's the profit and loss on the income statement. And this is accounting profit and loss. So there are some non-cash items and also accounting things going on. So that's why we look at free cash flow when we value a company. But net income is also important, and it's part of the model. Now I'm pulling the revenue, which are the sales for the company. And look how nice the numbers are. They're pretty consistent. There's no negatives. And it seems to be growing each year. Revenue has increased. Not a lot, but it's been increasing every year. Let's look at a capital structure, and they have no debt. They were able to generate $3.5 billion of revenue a year with no debt financing. They did it all through equity. Let's figure out the cost of equity, and we need the beta. That's how much a stock moves relative to the entire market. And look how low that beta is, 0.12. It's a really safe stock. It's not going to move too much. The lower the beta, the lower the WACC, which is a discount rate we use. Let's get the current assets, because we need to look at the current ratio later. And current assets are mainly cash, accounts receivables, and inventory. And that's how a company runs its day-to-day business with their current assets. Let's get the current liabilities. That's what the company owes within the next 12 months. That's $290 million. Let's get the equity. That's assets minus liabilities. And that's $1 billion. And their EBIT, earnings before interest and taxes. That's on the income statement, and it's called operating income on the income statement. That's $84 million. Let's look at the capital structure of the company. No debt. The equity is only cost them 3.24%. So that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows based off of prior financial information. We also estimated a terminal value, which is all years past year 4. We discounted those numbers back to today's value using the weighted average cost of capital, and we get a value of the entire company of $4.4 billion. We divide that by 27 million shares, and we get an intrinsic stock price of $162. They're trading at $49, so they're trading at a 70% discount. So it's definitely a buy according to the model. Let's see what Simply Wall Street values the company at. They're valuing them even higher at $212. So that's what I'm saying. This company is a real gem that not many people are familiar with, even though they've been trading in the market for almost 60 years. Let's look at the historical stock price. The stock was trading, it looks like about 65 a few years ago, and it definitely dropped, but it's come back up. It looks like it's actually increased during coronavirus. It's come back down a little bit, but coronavirus doesn't seem to have affected this company's stock. Now, just because a stock is undervalued doesn't mean the price is going to go up. Even if a stock is worth 10 times what it's trading at, it doesn't mean you're going to make any money. The only way you're going to make money is if more people buy the stock and force the price higher. So even if you're able to identify a price mismatch, it doesn't mean you're going to make money, and you might have to wait a long time. I did a video last month on WIMI. Let's take a look at WIMI hologram, and we're going to see if we can figure out the stock price for this company. The market cap is 200.8 million. It's a pretty small company. And the stock price is 340. And we estimated the future cash flows for 4 years. Then we did a terminal value. And it's not a big number, the terminal value, because that's all years beyond year 4. Just because the model takes into account how much debt a company has, the capital structure, and some other things. So the terminal value got reduced a lot. But it's better to be conservative than aggressive, especially when investing in stocks. So when we discount these numbers back to today's value, we get a $488 million value of the company. And when we divide it by 59 million shares, it's a stock price of $8, and it's trading at 340. So it is trading at a 59% discount, even with a conservative model. And you can see historically, it never really traded much higher than maybe 5.25. So it's always been trading at a discount. And for 5 weeks, the stock didn't move. Then 2 days ago on Friday the 12th, the stock tripled in price. And that video got so many views over the weekend, and a lot of people made videos on that company talking about it, but no one made it before the stock went up, except me. But I didn't know when it was going to go up. Obviously, if I knew, I would have put all my money into it. It could have never went up. The stock market is like a large group of buyers and sellers. So if you own something, it could be anything. Say you own a car. If you want to sell it, you might not be able to sell it for what you're asking. If you want $10,000 for it, you might not be able to find that person who really wants your car, even though there's probably people out there. It's just hard to find those people. The stock market's a little easier because it's all electronic. But still, there might not be people out there willing to pay $100 for this stock because they just don't know about the company. There's just not enough news about them. Let's look at the financial ratios to get more information. So they have a fairly high PE of 19.3. That's price of stock over earnings per share. They have a really good price to sales ratio of 0.4. That's price of stock over sales per share. Also a good price to book ratio of 1.2. That's price of stock over book value per share. Let's look at the current ratio. That's 1.7, so they can cover their current liabilities. ROE is 6%, so they're not providing a good value to their equity holders. Remember, equity holders are us, the investors. ROE is net income over equity. Grocery stores are notoriously bad for providing good profit margins. No interest coverage ratio because they don't have any debt or interest payments. So this could be a good long-term stock, and there's really no predicting when the market will realize this is such a good value. So the stock market is forward-thinking, and people invest to the future, not what companies have done in the past. But this company has a pretty good track record. So I think it's just a matter of time until they blow up. And I just don't know exactly when, and nobody really knows that. But thanks for watching the video.